Hey there, everyone. It's Wednesday, May 8th, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist at Stockcharts.com, not from a cloudy Redmond, Washington today, from a very sunny Silicon Valley in Northern California. We're going to talk about the market conditions today on the show, particularly NASDAQ slightly lower, S&P flat, Dow higher. When you look at the sectors that are leading, utilities continues to sit at the top of the leaderboard. A lot of charts to cover, so let's get right to the market recap. So let's start off looking at the major averages here on our market dashboard. You can see the S&P almost perfectly flat for the day, ending not far from where we ended yesterday's close, right around 51.88. You can see yesterday's close, we had a bit of a choppiness, but mostly higher in the last hour of trading. Today, another kind of upswing. We came off just in the last 5-10 minutes, but overall, I think the big story here is we opened much lower, but very quickly in the first hour of trading had regained yesterday's close, but never got much further. So end of the day, directionally, not much going on with the S&P 500. You can see the NASDAQ spent most of the day below the zero line there, finished down 0.2%. The Dow, though, having a day up 0.4%. So, it's not lights out, in crazy buy conditions. However, it's worth noting again, you have the NASDAQ slightly down, the Dow higher. And when you look to the right and glance at the sectors at the top of the list, probably tells you what you need to know about why that differentiation has happened between our major averages. More of a value tilt, of course, to the Dow than the S&P and the NASDAQ. The VIX pushing again about a quarter point lower, ending the day right around 13. So we remain in a low volatility environment. I talked, I think on yesterday's show about high yield spreads remaining fairly tight. And what that means when you have tighter high yield spreads is basically that bond investors are seeing very much a risk-on environment. They're happy taking on additional risk. No real concerns at the moment, relatively speaking. So what's interesting is you have low volatility, you have fairly tight credit spreads, and overall those are pretty bullish configurations. So what are you looking for? You're looking for the VIX to pop higher. If you're looking for a rotation lower, if you're looking for some sort of bearish rotation. I think when you have the short-term move generally higher here in the last couple of weeks, what would tell you something's different? I would say the VIX spiking above 15 would definitely be a red flag for me. High yield spreads widening out would be a red flag as well. We're not seeing either of those red flags emerging today. Interest rates overall moved a little bit higher today, but not by much. The 10-year yield finished today just below 4.5%, 5-year point right about the same. The long bond yield around 4.63. The short end of the curve right around 5.25, same as we were yesterday. So bond prices coming off today, yields going higher. I think that's another really interesting theme to look for. We'll look at the chart of the TNX, the 10-year yield, and the bond chart, TLT, here in a short while. Just check in on where they're at, because I would argue bond prices are testing key moving average resistance. I'm skeptical if we'll see bond prices moving a lot further than what we've seen so far. Gold slightly lower, about 0.3%. Silver slightly higher. Copper prices down. Crude oil prices up. Literally, it's a mixed bag right now. But gold and crude oil, the two that I look at the most often. Gold slightly lower, but again, not bad in terms of the year-to-date returns, outpacing the S&P and the NASDAQ, and it's not even been close. Gold really from sort of mid-March to mid-May now, completely crushing the S&P and the NASDAQ in terms of returns year-to-date. Crude oil prices popping up a little bit. Energy stocks not doing particularly well on a relative basis, but hanging in there. Bitcoin coming off over the last 24 hours. You can see it's currently around 61,550. It's down about 1.25%. Ether has gone below 3,000. Actually hasn't been below there for quite some time, if I remember to do so. I'm jotting it down to look at that a little later in our market recap. Looking at the 11 S&P sectors, you can see most down actually, right? So only 3 of the S&P sectors having a positive day. Utilities once again at the top of the list. And if you ask me to talk about, out of all the evidence I'm seeing, what is the most not bullish, or most not bullish, or most bearish indication right now, I would say utilities continuing to be at the top of the leaderboard on an average day does not make me feel particularly good. The relative strength on utilities has been quite strong here in recent weeks and indeed in recent months. And that influx of capital to utilities, and you look at some of the names making new highs, there's a bunch of utilities like CEG, First Energy, FE, NextEra, NEE. These are all, in significant uptrends recently. Utilities like that usually don't pop unless it's sort of a risk-off move, right? Utilities are a fairly defensive play. You go there when you want low volatility and high income, when you're concerned about market uncertainty, when you're uncertain about market conditions, and you're concerned about the potential for moving lower. As an individual investor, you have the ability to buy short ETFs, to use options, to hedge your positions with a lot of different tools that are available to you. For institutional investors, traditional money managers, they are maybe not able to use some of those hedging tools and capabilities. So as a result, you just have to get defensively positioned within your mandate. So if you're benchmarked to the S&P 500, you go to the utility sector or consumer staples or something like that as a way to ride out market uncertainty and just sort of assume that if the market goes lower, you will go down less low than the broad market indexes. That's the benefit of a low volatility trade. So utilities up 1%, financials up just over 1/3%, technology up 0.3% as well. Industrials were flat for the day. Everything else finished the day in the red. Real estate down almost 1%. Materials number 2 down about 0.5%, and the XLY consumer discretionary down 0.4%. Our market trend model as of last Friday's close remains bullish on all time frames. So no real change to that. Again, I don't change that model formally until Friday's close, but I like having that widget on my dashboard just to keep an eye on if there's any change, particularly in the short term, which can be a hint of something larger happening maybe down the road here. In terms of the leading mega cap growth stocks, as we might call the Magnificent Seven and Friends, you have Meta up the most, up 0.9%. Tesla continuing to be an underwhelming chart. I've met some Tesla bulls here at the Money Show in San Francisco, and again, what they are citing when they talk about the upside potential for Tesla are all the fundamental arguments, about the promise of things like the Tesla truck and all the technology that's being explored and everything. I can't disagree with that sort of innovation angle, but I can absolutely disagree with the fact that the chart looks anything but pretty negative, right? I mean, the stock's going lower. And what I've learned as a technical analyst is there are plenty of bad times to buy good companies. So even if Tesla does end up being a great innovator and a great business over the long term, in the short term, you're certainly not seeing that bid. Alphabet, by the way, coming down about 1% after threatening new all-time highs here recently. Let's go to a daily chart of the S&P and just check in on how things played out. I'm continuing to label have the label of a bear flag. It's becoming increasingly inaccurate of a way of defining the price action over the last couple of weeks, but now I just have to see how it played out. We sort of, we're not really breaking out of that upper end of the channel, not quite yet, but we're really, really close. I still see this as a potential bear flag pattern, or maybe just a classic ABC pattern. And I'd have to move this red arrow, because the way that these measurements work, by the way, is you basically take it from a breakdown. So assuming we don't break down until like another week or two, that now gives you a downside target a little higher, around 48.70. And so as this pattern would continue, if we do confirm it, you take it from the breakdown point where we would break down through that lower trend line. So, I've labeled this a potential bear flag pattern. It's certainly not confirmed that pattern yet. And I would tell you, I think this trend line is pretty important. So as long as we hold that, things are actually pretty good, and we're still in a short-term upswing, a tactical uptrend. We break that trend line support, things look different. What's striking to me is how much the market from early April to early May looks like late July to late August of last year, right? We made a new all-time high here in July of last year, made a new all-time high in March. We came down below the 50-day moving average to test a recent swing low in mid-August. We came down below the 50-day to test a recent swing low here in mid-April. We then had a counter trend bounce, which took us briefly above the 50-day moving average, and we saw the same thing right about there in late August. And then what happened here, the RSI stalled out at 60 as we made a lower high, and that is my question right here. So far, we have followed July and August of last year almost to the penny. I mean, it's remarkably similar how these two patterns are. What happened next here was we confirmed a lower high. The RSI never got above 60. We're kind of right there. And so I think we're at that point where if this is a counter trend rally, right about at the point where I would expect we'd be rolling over. And if not, then you have to think the most likely pattern is a return to previous highs around 52.50. And then you think about whether it's a double top. Then you look for a break above there. You look to see if that's on stronger or weaker momentum. We have to reassess, obviously, a very different pattern than what we've observed so far. So again, that comparison just continuing to stand out to me. Looking elsewhere here, I did want to talk briefly about interest rates. In my Mindful Investor live chart list, we have, where is it? I can't find the chart. There it is, 10-year value and growth and the yield curve. So this chart, if you've not watched the show for too long here, has three panels. The top panel is $TNX, which is a 10-year Treasury yield index that comes from the CBOE. It's quoted at 10 times the yield. So if it's at 44.92, that means the current 10-year yield is 4.492%, is how you read that. And once you get that methodology, the numbers make a lot of sense. People kind of get confused sometimes when they first see that's all they're doing. And it has to do with how the options were quoted that this index is used to. The options are based off of this index, and so I think it's a better way of quoting it. But that's kind of what it is. So 10-year yield right below 4.5%, which is where we're at. Look at how yields have come off here in the last 2 weeks. When you think about this counter trend rally in the S&P, right? This sort of potential bear flag pattern, at the very least a tactical rally that coincides with this drop in rates. We've seen risk assets pop higher as rates have come off. And that intuitively would tell you that if rates start to bottom out here and push higher, most likely that coincides with the next leg lower in stock prices. And what's interesting there is if you look at $TNX, we're nearing an ascending 50-day moving average, which has served as support here recently. But if you go to the TLT, which is bond prices, this is not corporate bonds, but treasury bonds. And if you look, we sort of, I think we're clearly in a downtrend. I have this purple trend line just highlighting clear trend line resistance from the December high, the February, really late January high, two highs in March, and that's just slightly above current levels, right around $92 for the TLT. We were just below that level. We're also testing a confluence of moving average resistance as the RSI is nearing the upper end of the range where it tends to be in an overall bearish phase. So you have in the short term bond prices, obviously along with stock prices, rallying higher. For the TLT, we're rallying into a confluence of resistance. We're rallying into trendline support. The RSI is right where you might expect it to roll over if this is a short-term top. So I think we're potentially at an inflection point where bonds might have had their move. They start to rotate lower. Look for stocks to come down along with bonds, I would argue, if that is the situation. Quickly, let's check in on the cryptos. If you look at Bitcoin, you can see that we continue similar to the bond price chart, right? You have this pattern of lower highs and lower lows. We've now had a move higher. We got down to around 57,000 traded, and that's about a 50% retracement, by the way, of the January to March rally. We've bounced higher and now found resistance once again at a descending 50-day moving average. That sort of pattern with the RSI consistently below 60, this tells you we're in a downtrend. So you see a pattern of lower highs and lower lows, which I certainly do. And so the way that I think you generally play a pattern like this is you assume a particular primary trend, right? What's that main direction on the time frame of interest? For my time frame that I'm thinking about, looking about a month or two out, it certainly looks like it's a downtrend. It's guilty until proven innocent. So we have a pattern of lower highs and lower lows. At some point that changes because we make a higher low and we make a higher high. And until that happens, the downtrend is in play. I would also argue when you've had these sort of pullbacks before, breaking back above the 50-day moving average has usually been a pretty good signal to get back into Bitcoin and ride it higher. So since the Bitcoin halving in April, this has followed the pretty classic halving playbook, which is weak in the short term, usually for the next month or so. It's a weaker price action, but the long-term trend usually resumes in earnest later in the 6 to 12 months after. And that potentially is what we see with Bitcoin, but have to make a higher low and a higher high at some point. Otherwise, that's not what's happening here. Ether prices, by the way, back below 3,000. We've been really rotating around that level in April and May. Ether prices above 3,000, much better than below. But same with Bitcoin. What's a little different here is we have actually found some stable support right in that 28 to 2,900 level, kind of heading back down to that range. The RSI is overall in a bearish configuration. Like to see this break to a new swing high, break above the 50-day, the RSI improve, ideally get above 60 on a rally rally, that's usually the sign that conditions are really getting strong. Look at when the RSIs have been fairly low and then become overbought. That overbought move has ended up being the beginning of the move in October of last year, the beginning of the move in February of this year, and I would argue that another overbought move here on a rally could indicate that next leg higher. Let's finish off looking at some individual names. We're sort of winding down earnings season, but there are some movements to report on. Wynn, talk about a couple names that reported after the close yesterday as we were recording our show. Wynn Resorts had a couple gambling names come out here in the last week. Wynn, a bit of a disappointment, down about 1.5%. Sort of had this double top pattern in February and April, right around $106 to $108 a share. We've now come back down, undercut that, and now we're right at the 200-day yet again. Breaking below the 200-day moving average is usually not a good thing for a chart like this, particularly one that's had a series of breakdowns below that level. So you're looking for that pattern to break, right? You're looking for that pattern to change. But I would argue finishing below the 200-day moving average this week could indicate a higher likelihood of further deterioration. Speaking of deterioration, Oxy is an energy company. Not a lot of energy names reporting this week. A lot of them were a little earlier in the earnings season. But Oxy, after making a new swing high in April, has started to pound out this pattern of lower highs and lower lows. You might call this a flag or a bull flag. I'd probably label it more of like a wedge pattern, which is where it's not really a parallel channel, but more consolidated. I probably have to draw the lines to confirm that. But in any case, that trend line using the previous highs, you have to wait for that to break, for that pattern to change. Overall, this is a vulnerable chart appearing to head back to its 200-day moving average. Sonos also reported after the close yesterday. Interesting action today because it opened lower, right around 16 and a quarter, we'll call it. Ended up chopping around quite a bit, almost got down to the 200-day moving average, but closed back at the highs for the day. And I think that's the most encouraging part of this. Earlier in the day, it looked like this swing low from April was going to be broken. We opened below there, but we closed right back up at that level. So I think that level remains a key support level that, based on the closing action, has not been violated just yet. So the question is going to be, do we continue to move lower or do we regain the 50-day moving average? I think that move, whatever that direction of momentum is after this, is going to be pretty key. Kinross Gold, KGC, reported after the close. A couple of these gold stocks, KGC, Agnico, AEM, and some others, right around new all-time highs, or new 52-week highs, that is, and KGC making a new high today, up almost 5% on a strong earnings report. Relative strength making a new 12-month high today, which I think is pretty encouraging. Before the open today, we did have a handful of names. Shopify is one I wanted to highlight. Disappointing earnings report. Our stock gapping lower. Had briefly gone above the 50-day moving average. Looked like it was a potential short-term breakout here, but earnings really crushing those dreams. We're now below the 200-day moving average. Chart like this, I think you avoid until you see signs of accumulation. Now, the last time we were below the 200-day moving average, we traded down for a little while, and then we had I think this was earnings there. In early November, we gapped higher, and that was the beginning of a nice multi-month move to the upside. So you're looking for some sign of accumulation, some sign that we're finding stability. I'm not seeing that on the chart just yet. Finally, Applovin reporting after the close here today. And the reason why I want to highlight this one, because it's in a primary uptrend, right? Higher highs, higher lows. It's above two upward sloping moving averages. Recently, a couple weeks ago in mid-April, we tested an ascending 50-day moving average. Overall, that's holding, but now we are attempting to get above the April high. We've not done that just yet. The RSI is constructive. The relative strength story is good. It's all about whether this stock can continue to build on these incredible gains that it's experienced over the last 16 months or so off of the December 22 low. I think this earnings season could be a big one, because if you look, the last earnings report in February, that was a big gap that led to much more additional gains. Do we see a repeat? Can we get above $78, $80 a share? If so, I think that's a continuation signal on a strong uptrend.
Well, that'll do it for today's episode. Thanks so much for watching us every weekday after the close for the final bar. We should be headed back to Seattle first thing tomorrow morning, so we'll hope to do the show tomorrow back at the home office in Redmond. But until then, be well, stay safe, have a good night.